This is the Captain Crypto Show, navigating the treacherous seas of cryptocurrency to help you arrive into port safely and secure your loot. Here's your host, Kylan Hurt.
Ahoy, ye swashbucklers! Now that we're back on the high seas, and we have plenty of rations for all of our crew, I think it's time that we hunted for some treasure. I know from experience that there's plenty of gold and silver and gems out there, just ready for the plundering. So it looks like we're going to be getting ourselves in quite an adventure here. And that means that our crew's got some big decisions to make.
Alright, now that we've completed our first 3 episodes of what is Bitcoin and what gives it value, and how to get and store Bitcoin and other cryptocurrency, that means now that it's time for us to actually decide which cryptocurrencies to buy. Although some of you may have already purchased some Bitcoin or other cryptocurrency from episode 2, today I'm going to go over the criteria that I look for when I'm considering buying cryptocurrency. Now, I've given this disclaimer before, and I'll give it again. The topic that we'll cover today only reflects my own personal strategy for purchasing cryptocurrency. That means that this episode does not constitute financial advice. I am not a financial advisor, and you are responsible for making your own decisions. But, since I am Captain Crypto, and I know plenty of you are still beginners, I figured I would at least shed some light on how I decide which cryptocurrencies to buy, so that hopefully you can use that information to help get your bearings. I feel that I should also clarify here that just like I mentioned in episode 2, that I don't look at cryptocurrency as a get-rich-quick scheme, and the items that I go over here in this episode are in accordance with that. They are made with the assumption that someone is looking at cryptocurrency as an investment opportunity in the medium or long term. If you're looking for advice on how to day trade cryptocurrency, or some sort of strategy to analyze the daily charts, then just know that there are plenty of resources out there for this. Just go on YouTube and search cryptocurrency technical analysis, and countless results will show up. Another thing to keep in mind for this lesson is that in cryptocurrency, there are very few absolutes. So just because I say that I like something or don't like something, does not mean that there are no exceptions. In fact, in the world of cryptocurrency, we see our own preconceived notions challenged, often enough to know that we need to keep an open mind. So, with that said, we're going to head to the bow of this ship and use our spyglass to try to check out what kind of cryptocurrencies are out on the horizon. So, when it comes to cryptocurrency, the criteria that I use in order to decide which cryptocurrencies to buy is more or less split up into 2 parts. The first are innate or fundamental characteristics of a cryptocurrency, and the second list, for lack of a better term, we'll just call secondary characteristics. Obviously, it would make the most sense for us to start off with the list of innate or fundamental characteristics. So, this first list has 7 items in it, although I do reserve the right to add or remove items at any given point. Now, I'm going to try to put these in an order, from least important to most important, but the truth is, at times it's really hard to compare how important some of these items are relative to the others. But I'll still try anyways. So, starting off with number 7, we have legality. This simply means, how does your government and other governments treat this cryptocurrency? Is it legal? Is it illegal and prohibited? Or is it legal with certain restrictions? This factor has historically had a large effect on the price of cryptocurrencies. For example, when the Chinese government has cracked down on Bitcoin or Ethereum, we've seen immediate and drastic price drops. Conversely, if there are rumors that a government is about to embrace a cryptocurrency, that can often cause the price to rally. Additionally, legality will also give you an idea of how easy or hard it will be in your jurisdiction to buy into a cryptocurrency or to cash back out into fiat. In general, it's a good idea to stay familiar with your jurisdiction's stance toward cryptocurrency. All the cryptocurrency in the world isn't going to mean much when you're living life behind bars. Number 6 on the list is project history. This simply means if you've looked at the history of the project, has it been a history filled with successes or one filled with failures and scams? A lot of times, once a cryptocurrency project has experienced a major scam, it will give that cryptocurrency a bad image, and that project may be branded as one for people to stay away from. And if people are staying away from a cryptocurrency, then there's a good chance that the price is not going to be doing very well. On the other hand, if a project has already faced many challenges, and it's come out on the other side looking stronger, then that may be a good indicator that that cryptocurrency may also be able to tackle future challenges. Number 5 on the list is market capitalization and the effect of recent developments on price. Now, there is some debate about how useful market capitalization is as a tool for measuring a cryptocurrency. And here's one of the reasons why. For those of you who are not familiar with the term market capitalization, which is also shortened to market cap, it's a tool that historically has been used to measure the size of a company. The market capitalization, which is usually denominated in a currency, is equal to the price per share multiplied by the number of shares that exist. For example, if I have a company that has 1,000 shares, and each share is worth $1,000, then 1,000 times 1,000 is 1 million. My company has a market capitalization of $1 million. So you'll often hear people refer to this term, especially when talking about big corporations like Apple or Microsoft. And while you can use this same equation to measure the size of a cryptocurrency, that also means that it's not a perfect fit, because Bitcoin and most cryptocurrencies are not a company. There's also the more complicated question of how does one decide what the price is? Do we look at how much it's trading for on an exchange? If so, then which exchange? Will we take the average from the last day or the price of the last transaction? If I get some patsy to sell me their Bitcoin for $1, does that mean that the value of all Bitcoins is $1 each? These are just rhetorical questions worth thinking about. Now, with regard to the effect of recent developments on price, if you're hoping to use a cryptocurrency as an investment for the short or medium term, then it would make the most sense to try to purchase the cryptocurrency before positive news comes out. That way, once the news actually breaks, if it's good enough news, it'll cause the price to go up. And if you're holding that cryptocurrency, then the value of your holdings has just increased. But here's where it gets a little bit tricky. If the cryptocurrency market overreacts to news, which it does fairly often, that means that after the price increase, there may be what they call a market correction, where the price declines until it finds equilibrium. So if you happen to purchase a cryptocurrency at a time when the price does not properly reflect the news or the long-term value of the coin, then you could see the price drop and the value of your holdings decrease. Obviously, that's a situation that we're trying to avoid. The fourth item on this list is to take a look at the founder of that project, and maybe even read up on their white paper. For those of you who don't know what a white paper is, it's the original document that officially explains what the project is intending to do. For example, in November of 2008, Bitcoin's white paper was released by its founder, Satoshi Nakamoto. The document is only about 12 pages long, and I highly recommend you take a look at it. And in the paper, Satoshi explains how Bitcoin will work and how they intend it to be used. Now, the interesting thing with Bitcoin is that no one's entirely sure who Satoshi Nakamoto is. There are plenty of theories, but it doesn't seem like the community can reach a consensus on who it is. In contrast, Ethereum's white paper was written and released by a Russian coder by the name of Vitalik Buterin. As much as the original creator of Bitcoin has stayed out of public light, Vitalik Buterin has actually been fairly public. You can see videos on YouTube of him explaining Ethereum, and you'll even read articles about what he's been up to. If you read through the white paper and it doesn't make any sense, or it seems like it's authored by someone shady, then that's probably the type of project that you should avoid. Alright, so item number 3 on our list is centralization or trust. When it comes to a cryptocurrency, are all people using the cryptocurrency equal? Do all the people using the cryptocurrency have equal power? How about the miners? How about the companies developing applications on it? Perhaps most importantly, is there a central entity behind this cryptocurrency that has enough power that if they were to disappear tomorrow, the cryptocurrency would be in shambles? If so, then I would personally avoid that project. Another example of this is that some projects have what they call master nodes. And these master nodes, in contrast to a regular node, are given more power and more privileges. This may put a lot of power in the hands of a few, and that's the sort of situation that some of us are trying to avoid. Okay, so item number 2 on our list is, does the cryptocurrency have a use case? And if so, how much potential for growth is there for that use case? If the currency is trying to replace something as ubiquitous as cash, then that likely means that there's a lot of room to grow. Or maybe it's a token looking to be used by online gamers. That would still be a large use case, but not quite as big as something like cash. Or maybe the currency is looking to be used on a platform for programmable money. In my opinion, it's safe to say that being able to program your money in the future is something that just about everybody would be looking to use. Maybe the currency or token is looking to be used for cloud storage or cloud computing. Those are certainly big industries, but they are also ones with pretty stiff competition. In general, if there's a large use case for the currency, that means that there's a potential for very high demand. This leads us to the number one item, for criteria that I look for when buying cryptocurrency. So, can we get a drum roll? And I feel like it's taken me years to figure this one out. The factor that I deem to be the most important when it comes to picking a cryptocurrency to buy is simply the community around that currency. Ask yourself what kind of personalities are involved with this currency. When you see articles written about this cryptocurrency online, what kind of comments do you see? Are people polite or are they rude? The atmosphere in some cryptocurrency communities has at times become toxic, and that sort of toxicity takes a toll on the currency itself. A toxic environment can also lead to developers leaving the project, a virtual brain drain, and that usually does not bode well for the project. Alright, so that's the end of our innate or our fundamental list. We're going to take a quick break, and when we come back, we're going to take a look at the criteria of factors that I consider to be secondary, but still relevant. For those of you listeners out there enjoying the show, I'd love to get your feedback on how I can improve it. I can be found on Twitter at CaptainCryptoHD and on most social media as Captain Crypto or Captain Crypto Show. Whatever the platform, just look for my logo. Also, be aware that due to the technical aspects of each platform, that my podcast feed will always have the most up-to-date and latest revisions of each episode. So, if you're enjoying this podcast, please give us a review on iTunes or share this episode on social media. Now, back to the show. Alright, welcome back. So now, unlike our first list, this list contains 8 items, but is in no particular order. Our first item is confirmation times. Now, this will only apply to currencies and not to tokens, since tokens are not mined. A confirmation time is the average time that it takes for a transaction to go from pending or unconfirmed to confirmed. Now, if you'll remember, the more confirmation times that a transaction has, the less likely it is for that transaction to be reversed. Bitcoin has a confirmation time of 10 minutes. Now, this may be fine for big transactions, for example, if you're buying a car or a house, because in those situations, the value of the transaction is so high that you probably don't mind waiting for the transaction to get multiple confirmations. In contrast, however, if you happen to be doing smaller transactions, then waiting 10 minutes for each confirmation can seem like a hassle, especially since you have to move this currency around in order to be able to trade it. Imagine wanting to trade a currency because you know that the price is about to skyrocket and ending up missing out just because you had to wait an hour to get those funds into an exchange. That's a situation that many traders find themselves in, and it's never a fun one. Alright, our second item is programmability. It's simple to send and receive a transaction, but what else can this cryptocurrency do? For quite a while after its release, it didn't seem like Bitcoin had any major features other than send and receive. Its programmability has been extended since then, and one of the earliest examples of this is what they call a multi-signature wallet, or multisig for short. And what a multisig wallet does is that it can allow multiple private keys to control funds. This also means you can make it so that outgoing transactions can only occur when a majority of the private keys sign for a transaction. For example, you could make 2 out of 3 signatures be required in order for a transaction to occur. This is often used in situations like arbitration and escrow. Perhaps the most obvious example of a programmable currency is Ethereum. Among many other programmable features, Ethereum allows smart contracts and decentralized autonomous organizations. You may even be familiar with its ability to create ERC20 tokens, which can be distributed in a process that some of you may already know as an ICO, or initial coin offering. Ethereum is so programmable that many people see it as more of a platform than a currency, with Ether being seen more as fuel for the platform than an actual cryptocurrency. Our third item here is hashing power, meaning how much computing power is behind this cryptocurrency's network. The more hashing power that exists, the more resilient it will be to outside attack. Naturally, as of the recording of this episode, Bitcoin has by far the most hashing power. And if anyone wanted to wage an attack on the network, it would likely cost them billions of dollars, and there would still be no guarantee that it would work. In contrast, smaller altcoins often have much smaller hashing power. There have been actual instances where miners have waged a successful attack on some of these smaller altcoins. Although this can't be done for any reason, the examples I've seen are when miners think that the founder is a scammer. That's right, there are attacks even in cryptocurrency. And here you thought this stuff would be boring. The fourth item on the secondary list is scalability and block size. Now, if you're new to cryptocurrency, this might seem like a foreign topic. But since most cryptocurrencies use a blockchain that every full node is supposed to have a copy of, if the size of this blockchain becomes really large, then that means that it'll be costly or difficult for full nodes to keep a copy of the blockchain. And many people believe that the fewer full nodes that you have, the more centralized the cryptocurrency can become. This has been the basis for the Bitcoin scaling conflict. Related to the size of the blockchain is the size of individual blocks. For most of its history, Bitcoin has had a 1 megabyte block size limit. And since on average every 10 minutes a block is mined, that means the size of its blockchain can increase by up to 1 megabyte every 10 minutes. That 1 megabyte size limit was put in there to prevent the blockchain from increasing in size too rapidly. That has meant that transactions have to bid for a spot in that block, much like an auction. And this has caused an increase in transaction fees, which has made many users unhappy. In general, as more people use a cryptocurrency, its blockchain size will start to increase exponentially, and/or its transaction fees will increase. Our fifth item in this list is what we call a pre-mine. And since the founders and developers of any project are initially the only ones that know about it, that means that they can start mining it long before anyone else even knows how to mine it. Some argue that this is a legitimate way for a project to raise funds. Others argue that it's just a get-rich-quick scheme. It's something that could be debated all day, but in general, I like to see a project get things done and raise funds in a more organic way before resorting to strategies like pre-mining. Our sixth item in this list is governance. Who decides in which direction this cryptocurrency or this project is going to head? Is it the miners? Is it the users? Is it the nodes? Is it the master nodes? Or now, with proof of stake, could it be the people who are actually holding the currency? And I'm not talking about who's saying that they want things to head in a certain direction. I mean, ultimately, who has the power to decide which transactions are valid or invalid? Bitcoin follows a proof-of-work algorithm, which means that miners get the ultimate say. Naturally, it's not that simple, though, since if they're mining a currency that no users want to use, then they'll be mining a currency that's worthless. Proof of stake is another major governance system that is employed by some projects and eventually will also be used by Ethereum. In this governance system, it's the users who currently hold the currency that get to decide which transactions are valid. Each vote is usually weighed proportionally to how much of the currency that user is holding. For the most part, proof of stake is still fairly experimental. But then again, in cryptocurrency, what's not? Our seventh item in this list is the inflation rate. Since price is determined by supply and demand, that means that supply, or how many outstanding units there are of a currency, is one of the two critical variables for determining the price of a cryptocurrency. And by supply, I mean how many outstanding units are there of this currency, and how quickly are new units being created. If you're thinking about meta tokens, then maybe there will be no more units created. There are currently somewhere around 17 million units of Bitcoin that have already been created, and that amount is going to max out at 21 million. That means that since supply is not really going to increase by very much, that any major increases in demand are likely to cause a significant increase in price. Alright, and that leads us to the last item on the secondary list, which is privacy. Some cryptocurrencies pride themselves on being very anonymous and untraceable or unlinkable. Others make use of being public. In general, I've found that if a currency has picked either to be very anonymous or very public, then that's fine. Where I've found some cryptocurrencies lacking is when they try hard to do both. When it comes to privacy, everyone wants to be rich, but you can also become a target if people know that you're rich. Conversely, if a cryptocurrency is trying to be transparent, then that currency can become useful for verification processes. You don't have to like one way or the other. Just know which strategy is the correct one for each use case. So there you have it, my list of secondary criteria. Now I've tried purposefully not to give too many examples of which cryptocurrencies are good and bad on each of these items. Mostly because cryptocurrencies change over time, and I don't want the information in this episode becoming obsolete. But also to a lesser extent because I'm not trying to make any enemies. There are a lot of people who have a lot of money on the line for some of these cryptocurrencies, and the last thing they want to hear is someone criticizing them. I also don't want to come off as a shill, because while I want the cryptocurrencies that I'm holding to do well, I want you guys to know that I try my best to make sure that that does not taint the information in these episodes. Alright, so now that we've come to the end of this episode, I know we promised to have a little bit of a surprise ready for you this time around, but unfortunately it's not quite ready yet. I'd like to give another shout out to Stargate Pioneer of GonnaGeek.com for doing the vocals on the intro. So, as Bitcoin continues to hit all-time highs, just remember when it comes to the world of cryptocurrency, set sail.